So Austin, I want to get a mortgage, but I got two big problems. I don't have a job and I have no income. What can I do?
Those are two big problems indeed when you need to borrow money. But that is what this video is all about. All right, so Jonathan, that's a great question. Income is super important when you're borrowing money because we have to make sure that you have the ability to repay.
Sounds important.
Yeah, because you could have a bunch of money and who knows, maybe you go buy a yacht, you know.
Or put it on black at the casino.
Yeah, now how are you paying back the mortgage? And so the income is a huge piece of that. And so the thing that we talk about all the time with qualifying somebody when we're looking at their ability to repay is a little phrase you might have heard, debt to income ratio. So when we're talking about debt to income ratio, we're talking about your debt obligations divided by your income. That's how all of the loans that we work with base their qualifications off of it. So if you don't have a job and you don't have income, how do we get around that?
That's important because a lot of agents ask us, or buyers, like, what's my purchasing power? How much I qualify to borrow? And what Austin's talking about is the debt to income ratio. And so the income is 50% of that puzzle, and it's really important. In the majority of our loan programs, you got to be at 43 to 50% DTI. And so it's really important. Yep. But let's look at the next slide and figure out how do we get around those things, Austin?
Yeah, so when we're looking at this, let's say you've got a lot of money, right? Or so, okay, you don't have a job, you don't have income, but you've got plenty of assets. Or maybe you do have a job and you do have income, but it just changed and for whatever reason, it's not qualifiable. Like you just went from W-2 to 1099 or you just started your own business. Yeah. You might be crushing it, but we can't use that income until we've got enough history on that. So if you're in one of those situations or you don't have one, these are the ways that we tackle those problems. And so the first way is by using an asset utilization loan program. And we'll break that down in a second. The other way is by using just a traditional Roth IRA for setting up a retirement distribution. So Jonathan, break down the asset.
Yeah, so you might have heard bank statement loan, asset utilization loan, or asset depletion. These are all kind of generic terms for the program that we're talking about. It's essentially for the borrower who has no job, has no income, but has a lot of money in the bank. And so you can see from the slide that's up right now, whether it's in cash or CDs or stocks or bonds or in a Roth IRA or a taxable stock account, it doesn't matter. All those are qualifiable assets. And with the asset utilization program that we have, we can take those qualified assets and divide them by 120 months and then create monthly income for you. And that's one of the ways we can get you in a house without a job or income.
Man, that's beautiful. And so you can see on that slide that there's a difference on what type of account it is and how much you're able to get qualified income out of from that account. But it's awesome to have all those options. The other thing is the IRA distribution. So on the slide, you can see we can actually use 100% of your IRA assets. And what we do is we look at the IRA and we just simply divide that total number by 36. We want to make sure that there's enough in there to have a 36-month, 3-year payout toward the mortgage. And so as long as we can get 3 years worth of payments out of it, we're going to be good with using that as your income.
Yeah, so that's a Fannie Mae requirement and one of the easiest ways to get our buyers in a house.
It's one of our favorite get out jail free cards. So on the next slide, we're going to break down what the asset utilization looks like for one of these examples.
Yeah, so if you're looking at the numbers right now, let's imagine you have 3 million, you know, full of Google, Apple, all those great stock names, Amazon, you got 3 million in there. Well, obviously the market moves up and it moves down, so we're not going to be able to give you 100% of that. So we're going to take 70% of that. So you take whatever that asset is, multiply by 0.7, and so you're going to end up with 2.1 million. And then we're going to divide that by 120 months because we want to have continuance of all of that. And so with that breakdown, we could create $17,500 of monthly income for you. And so if we have programs that programs that go up to 43 or 50% DTI, that means you can maybe get a mortgage up to $8,000 depending on, you know, your other liabilities and things that are going on. So
that's exactly right.
So that's a beautiful way that the asset utilization program works.
Yeah, that'll get you somewhere. On the next slide, we're going to walk you through the IRA distribution example. So let's say you've got $1 million in your Roth or your non-Roth IRA. That breaks down to dividing that thing by 36, right? We got to divide this. We can give you 100% credit for it. We divide it by 36 months. That gives us $27,000 and change to use as income.
That is beautiful.
That is hefty.
Yeah, and so I guess one of the things we want to say, a lot of people are like, well, retirement accounts, I'm not 59 and a half years old, Austin, I'm 45 or 50, like I can't do that,
That's
right?
right. That's
so
right.
The way it works is we need a letter from your CPA or financial advisor stating that, you know, the borrower is going to be taking, you know, 5,000 or 10,000. I guess in our example, it's 27,000.
27,000.
That's a lot, but showing that they're moving it from their IRA account to their joint checking account. And so we need some type of letter, professional letter from your CPA so that we have proof of the IRA distributions getting set up.
Yep.
And then we need to have that 1 month of it starting. So we need it deposited or withdrawn prior to closing. And so back to being 45 years old, people are like, I can't do that. I'm about to pay penalties and fees and stuff. And I'm like, you only got to pull it one time.
Yep.
And so the payment penalties, or fees are minimum, and it's the only way to get you in a house. I think that's a easy cost to get the house that you want.
For sure. And I think it's important to point out that on the IRA distribution example, like you said, there has to be at least one distribution. So we're not just looking at your total that's in there and being like, okay, yeah, we're good. On this, you actually have to set up the distribution. You are using it to generate cash flow coming to you from that IRA, and that's the cash that we're using to qualify you for the loan.
Yeah. So if you're in my situation as the character I'm playing today, and you have no job and you have no income, or you're like Austin said, you just went 1099 or got a business that's just getting off the ground, we have a way to get you into a house and qualify for your mortgage if you have all these asset requirements that you can meet.
Yeah, so you might not make money, but you better have money if you need a mortgage. That's it for today. That's how we make mortgages simple. We'll see you around.
Adios.